Hello, everybody, and welcome back. Sustainable investing is probably one of the investment megatrends of this century. In terms of equity investments, many eyes are currently once again on the United States. For us, it therefore makes a lot of sense to combine both topics. My guest today is Mary Jane McQuillen, Head of ESG and Portfolio Manager at ClearBridge for the ClearBridge Sustainability Leaders strategy. Welcome, MJ.
Thank you very much, Thomas. It's a pleasure to be here. If I may just give one sentence about ClearBridge for those who are not familiar. ClearBridge is a global listed equity manager. We're based in New York City, and we have over 60 years of active equity experience and 35 years of sustainable investing experience, of which I have 27 years in sustainable investing. ClearBridge is also the largest equity affiliate of Franklin Templeton.
Wow, 27 years in investing. That's really impressive, MJ.
I started when I was 15.
Wow, that's early. MJ, the banking crisis involving Silicon Valley Bank has brought back unpleasant memories of the 2008 financial crisis. Is the threat to US banks over already?
I think first I should mention that we have two incredible financial sector analysts who have been highly diligent throughout this mini banking crisis with regard to our stocks. And so to your question, I'm not sure we can say that the threat to US stocks is 100% over, as there is still some nervousness among the regional banks. And as such, the larger money center banks like JP Morgan and others have been the recipients of deposits seeking safety. And it is our understanding that the Fed and the Treasury want to support regional banks as they are important to the health of communities around the country. And in the US, there are over 5,000 banks. And so while there have been a few recent high-profile regional bank failures, the regulators are working hard to make sure that financial systems stay strong and that depositors feel that their funds are secure. In fact, the regulators released their report on the failure of SVB, Silicon Valley Bank, last week and discussed the key missteps in the March banking crisis, including poor risk management, but also importantly, they discussed the likelihood of tougher regulation forthcoming. A few of the proposals in that report included or related to the tightening of the framework for managing interest rate and liquidity risks, such as tightening liquidity requirements for a broader range of firms, stricter capital requirements to count unrealized gains and losses on available for sale securities as part of the regulatory capital, and tougher standards for incentive comp, tying it closer to risk management.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much. And enjoy the video now.
What is the probability of an economic downturn in the current stage and in the second half of the year? And what does this mean for your portfolio and for your portfolio decision for the US Sustainability Leaders portfolio?
Well, we have a very strong investment strategy team at ClearBridge, and based on their proprietary recession dashboard, which has 12 indicators related to consumer, business activity, and financial. Today, 9 of the indicators are red, and 1 is yellow and 2 are green, which signals that we have about a 75% probability of a recession in Q3 of this year, and possibly, if not then, to Q1 of 24. However, we still have a very resilient or strong job market in the US, and the economy has been resilient. And before the pandemic, for example, there were 7 million job openings, and today there are 10 million job openings, which are primarily driven by small businesses, which make up 94% of the excess job openings. So though the slowing effects of the Fed tightening are beginning to appear and should weigh on economic growth in 2023, from a market perspective, we continue to see downside in earnings expectations and multiple compression as risks to equities in 2023. However, longer term, investors may want to take advantage of this volatility to invest for a 3 to 5 year time horizon, as bear markets are more rare and typically are great opportunities to take advantage of. In terms of the sustainability leader strategy, We have made some portfolio adjustments since last fall in light of our view of a potential downturn, such as being overweight in healthcare and consumer staples, typically more defensive types of companies. And we are underweight in financials, consumer discretionary, and about market weight in industrials. That said, we continue to have a bottom-up approach to stock selection and seek to identify high-quality investment opportunities with high returns on capital, low debt levels, recurring free cash flow generation, strong capital allocation, and high sustainability leadership.
Inflation and higher interest rates are dominating the market. So how does this affect especially sustainable stocks and sustainable equity investments in the United States?
In general, whether sustainable or not, in spite of inflation, the U.S. consumer has continued to spend. They're spending on travel, entertainment, retail, and credit card trends are going up. And wages have been rising as well, and the job market is still very strong. That said, personal savings rates have been moving back higher as well. And now in money market funds, which are paying 5+%, this is post the mini financial crisis, as depositors get a lot more for their money. So many consumers are choosing to save and spend less. In terms of recent workforce reduction headlines, job losses have been primarily in areas that have overhired during pandemic and post, and at relatively small levels. And some of the areas are in technology. For sustainable investments, higher interest rates can have impacts on the technology sector and renewable power, for example. However, both sectors have been resilient, and the thinking around this is a potentially higher cost of capital and longer duration investments. With regard to our portfolio, our investment risk team monitors our exposure to inflation and interest rate risk on a regular basis, and both are in line with our benchmark. We do not take major macro bets, and the majority of our risk comes from stock selection.
The US Inflation Reduction Act was the most important climate policy measure in recent times. So how has this affected US equities?
The Inflation Reduction Act, or the IRA, many of us who have been investing in a long time have been very excited about the passing of this act in September of 2022 by the US federal government. This is the largest fiscal commitment by the US federal government. As we know, the states have all had their individual commitments, but to bring the country together to address the climate risk is something that we were just very happy to see. So one of the things we can think about is the levelized cost of energy. So higher US demand for both renewables by corporations and by utilities. And this is something that we think about in terms of our investments. And so the IRA, which we know is $369 billion earmarked for energy and climate security, which was signed last fall, as I said, turbocharges or gives a lot of support for renewable energy deployment. It jumpstarts emerging technologies like battery storage, clean hydrogen, carbon capture and storage, and incentivizes U.S. manufacturing while highlighting fair wages and the responsible production of minerals necessary for the energy transition. And we talk a lot about just energy transition, which is, in our view, inclusion of underserved communities. And just to give you an example of the importance of renewable power and how it affects our portfolio, when we think about our strategy across various sectors, we have not since inception and by prospectus invest in traditional fossil fuels. So we have no oil and gas exposure, but we have been reallocating that type of exposure into clean power, into energy efficiency, into sectors such as IT, industrials, and utilities. And when we looked across our portfolio post the IRA signing, as you can imagine, a very large portion of our portfolio are standing to be beneficiaries of the IRA, straight out cash payments to support the climate work that they're doing for the next 10 plus years.
ClearBridge is a member of the Net Zero Asset Managers Initiative. So what exactly are the goals of this initiative and why does it matter for investors?
The Net Zero Asset Managers Initiative has set net zero commitments. It's the largest network or membership of asset managers focused on net zero commitments, which means 100% of assets under management by 2050 will be net zero. Or in other words, by 2040, 60% linear pathway by 2030 for us. In the spirit of Net Zero Asset Management Initiative, we also call it NZAM. Instead of Net Zero Asset Managers Initiative, we may call it NZAM. And in this spirit, we're seeking real world emissions reductions. We're not just simply shifting emissions from our portfolio to someone else's. So some may think, well, just divest, just sell all the highest emitting stocks. But is that really addressing real world emissions in terms of reductions? And portfolio carbon footprinting is a common or popular approach. It is helpful identifying the main source of emissions in portfolios, but we see it really as more backward looking and focused on historical. So from our perspective for ClearBridge, we're taking the portfolio coverage approach. We have a very robust engagement process where our fundamental analysts are engaging on with companies on trying to advance a decarbonization pathway for each company across every sector. So not just the high emitting, but sectors like technology and healthcare and consumer. And the other part that's interesting about net zero is that eventually you want to have an escalation policy. So over time, if we are finding that the companies are not committing to the Science-Based Targets Initiative, which is a form of verification that we believe is the most credible today, then we can put through an escalation policy. And in that escalation policy, one step is in our proxy voting, where we would vote against directors or the chair if we do not see a measurable amount of progress in their clean energy transition or climate mitigation strategy. But as far as why is it important, that's our job as investors. We need to understand which companies have the best chance of outperforming in the future. Understanding a company's plan for success in a decarbonizing economy is just a piece of this. So we think there are a lot of investment opportunities related to Net Zero Asset Managers Initiative's commitment, but we also think we have to start and we can't keep postponing and we have to start somewhere. And our investments is one area that asset managers have influence.
Greenwashing, of course, has become an image problem for sustainable investment. So how can investors identify real sustainable investment and strategies?
That's a very important topic that, as you know, the European Union has taken a big first step from a regulatory standpoint in setting regulation and guidance through SFDR, the Sustainable Finance Disclosure Regulation, as well as EU taxonomy. And what's interesting about that regulation is that the rest of the world, including the US and most countries, have been taking on more regulation or considering more regulation around greenwashing, which in the interest of investors is about more disclosure and understanding what you're investing in. So interestingly, for greenwashing, what has been a big problem, I shouldn't say a big problem, but which has been an issue is that the majority of new ESG or sustainable funds that have been launched as products have been just rebranded existing funds. So they're not necessarily funds that were created for the purpose, like Sustainability Leaders was created for the purpose as being a long-term sustainable investment option in equities. But these rebranded funds are taking existing strategies that have the track record, have the assets under management already, but then rebranding it. So if it was a large core, now it's a large core sustainable investment. That is something that investors should be aware of, or financial advisors as well. And a few ways that you can find these situations is you should look at the length and history of the track record under the sustainable investment label, not just recently. Many of them have been created in the past 2 years. So that's another sign. So the track records are not going to be as long as a sustainable investment. The experience of the management team in managing sustainable investments is another area to look for. Looking at the proxy voting or active ownership that the manager has and how they vote. These are indicators that investors can look at to see, is this truly a sustainable investment or is this one that's been rebranded and very recent to the market?
MJ, in general, what criteria do you use to select sustainable stocks and find long-term investment opportunities?
For ClearBridge and our predecessor firms, as I mentioned earlier, we have over 35 years in sustainable investing. It's been an investment in our infrastructure as well. So for us, what that means is that we treat sustainable investing as any type of investing, in the sense that our fundamental analysts have the responsibility and the remit to not only understand the fundamental issues, but also the sustainability research that is most relevant and most material for their analysis. So at our firm, all of our sector analysts are not only the financial analysts, but they're also the sustainability specialists. And why I think that's important is because if you are considering these are material and long-term investment issues, you really cannot outsource that thinking or that research. You can't outsource or source it to a third party. You can't buy it and bring it in. You can't hire a separate group that does the sustainable thinking, but then the fundamental analysts do the financial thinking. We have long believed that if this is an investment approach, we need the analysts to be on board for the entire process. So that said, we have a very strong, long history engagement approach. And what that means is that as a concentrated owner of the stocks in our portfolios, as a long-term owner, our fundamental analysts have excellent access to senior management, and they have the ability to communicate where they think, as an analyst, as a shareholder, these companies can not only improve in terms of their capital allocation policies, for example, but also in terms of their long-term sustainability strategy.
You are heavily invested in the IT sector. To what extent do Apple or Microsoft meet sustainable criteria?
Yes, Sustainability Leaders does have a very large weight, but it's just slightly overweight the bench, which is the Russell 3000. And as a US manager, we have some pretty large companies in the portfolio. We also have small companies. When we think of our IT sector exposure, it's in software and services with companies like Microsoft, like you mentioned, in hardware like Apple, but also in semiconductors, where we see a lot of interesting opportunities for renewable power and electric vehicles. So we think it's important to have the exposure that we have in IT, and our analysts will continue to analyze the fundamental view as well as the sustainability view. But just to give you a sense of Apple and Microsoft, so Apple has been a long holding at ClearBridge. Our analysts have not only engaged the company and more recently Tim Cook and prior on their best practices, but have also encouraged them to continue to do so. Many don't realize that Apple has taken a lot of very important steps in terms of sustainability. When we think of all the phones and the batteries, it's electronic waste recycling, e-waste. We think of the importance of security and data security and customer privacy. And then we also think about how it's manufactured. And based on the research our analysts have been able to source on the ground at the factories, for example, they've been able to see how Apple has come in using its large purchasing power. This is in China, but now it's also going to be in India and other parts of the world to set best practice. And labor is a much longer discussion in the supply chain. But from the work they've done over the years, our analysts, they found that Apple is not only trying to be a leader, but set the bar on how to treat workers, how to understand their needs. As you know, many of these workers in supply chains are migrant workers. Many of them are faced with what's called like a broker fee to get the job. Apple has worked to reimburse those broker fees back to the migrant worker who is working in the factory, because those fees could cost the worker's entire life salary and they will never get out of debt. So that's just an example of what Apple can do as a very large US company that has a lot of influence on its supply chain. Microsoft, as another example, is a company that we've engaged on sustainability. Our analysts have since 2003. And what that means is that for over almost 2 decades, just about 2 decades, the analysts were able to have access to management, provide feedback on areas that what can a software company do in terms of diversity, in terms of customer security, in terms of the digital divide. And how can the company continue to improve and access more renewable energy? Both Apple and Microsoft are some of the largest buyers of green power for their facilities, for their operations, their offices. And so our ability as analysts to speak with Microsoft as an investor has given them comfort that they can come to us, and they come to us once or twice a year to ask our views on sustainability. And our analyst who covers Microsoft has over 25 years covering software. And she provides some really important advice and recommendations that the company has listened to and has taken into consideration. So long story short, I think when you're asking, how do we think about sustainable investments? How do we go about this? It's very much a fundamental approach. It's a lot about engagement, and it's understanding what are the key issues for that specific company within that specific industry. And this goes across the entire portfolio. So it's something that we've done for a long time. And we found that, one of the key areas we have to think about is performance. And we believe this has contributed to our long-term performance success.
So this was Mary Jane McQuillen, Head of ESG and Portfolio Manager at ClearBridge. MJ, thank you very much for being with us today and sharing your insights into current trends in US equity and sustainability.
Thank you so much, Thomas. It's my pleasure.